Good morning. It is Monday, September 30th, 2024. We hope you had a nice weekend. First, I just have to start off with, just thoughts and prayers to everyone affected by Hurricane Helene. Just seeing some of the videos and images, just devastating. Here in Charleston, I think we were just far enough east where we saw very minor kind of impact. A lot of trees down and things, but nothing like what you're seeing. Even more in the upstate here of South Carolina, and then of course Florida, Georgia, Western North Carolina. Just really sad. So our thoughts and prayers go out there to everyone up in those regions that could use some help. So. Moving on here in terms of markets last week. Actually, I can't even go to markets. Just based on the feedback we received from last week's video, it seems like the viewership is much more interested in my daughter's soccer games than like Fed rate cuts. So just a quick update on the Rushing Otters, right? So another hard-fought game. We came out with a 1-1 tie. Okay, some strong goaltending, and then my daughter Keegan scored our lone goal to tie the game at 1. So everything good there. Really fun. So fun to coach. This age. Okay, kind of the question for the day. Kind of the primary topic. Should you make portfolio changes based on this new Chinese stimulus package? All right, and so for those of you that didn't see what's happening over in that region, so obviously the Communist Party, coming to the realization that their economy is not growing at the pace they would like, over the last week or so have come out with a number of stimulus measures. Okay. Lower rates, also pushing new money into their economy, and their stock market has just been on a tear. So the last, call it 10 days, really less than 2 weeks, their markets are up like 20 to 30% in less than 2 weeks, right? And like all the indices, right? So much like here in the U.S. where we have the Dow, the NASDAQ, the S&P, like all of their benchmarks, all of their indices, up 20 to 30%. I also read a headline, the Communist Party, they're allowing people to refinance, which I didn't even realize you couldn't refinance over there, but I guess that makes sense. That's just another good example of we take so many things for granted here in the United States, just having the freedom to do what apparently you couldn't refinance, loans and mortgages in China unless the government says you can. So I thought that was pretty mind-blowing, but nonetheless, so should you make portfolio changes based on these more accommodative measures in China? For those of you that have been working with us for some time, I think you already know the answer I'm going to give. It's going to be a resounding no. Okay, one, you never want to be reactionary in any market, right? If you're being reactionary, you're very late to the trade. You're likely, buying at a level that's too high, or you're selling at a level that's too low. That's a recipe for disaster. So you never want to be reactionary. But just in terms of asset allocation, absolutely not. The portfolios that we own on behalf of clients. Depending on the risk level and how aggressive we're trying to be, many of our clients do own a sliver of emerging markets, right, in which China would be a part of that. So a number of the families we serve are going to benefit a great deal from this rally, over the last week or so. With that being said, like the first thing I'm going to be doing this morning is checking, our models and our tolerance bands. Really good chance we're going to be selling a good chunk of China, in that emerging markets piece, because those positions are likely going overweight, where it's just a prudent thing to do. It's just math. Whether good chance of mean reversion, we're going to be selling a good chance of a piece of those positions and reallocating into other asset classes that are more underweight. So don't go chasing China and the Communist Party's promises. I think that might not go well in the long run. Just another couple quick notes here from last week. The PCE data, okay, so this is the Fed's preferred inflation metric, came in lower than expected, okay, so 0.1% month over month and 2.2% year over year. That's likely why we might have received that 0.5% interest rate cut last week, or 2 weeks ago, I guess now, and really it sets it up like I think more rate cuts are coming, which again we've talked about how that all plays out between stocks and bonds. And also on the docket this week we received ISM manufacturing, also some PMI data. So for us those are fun to look at as well. But we hope everyone has a great week. Questions, comments, concerns, please don't hesitate to reach out to our team, and we'll talk to you soon. Thanks.